Welcome back to the Deep Dive.
Good to be here.
Today we're getting into Church & Dwight, CHD's Q3 2025 earnings. The call was, what, October 31st?
That's right, yeah, Halloween. And the market reaction was, well, pretty strong, wasn't it?
Absolutely. Shares really jumped.
Yeah.
This wasn't just another, standard quarter report.
No, definitely not. It felt like maybe something's shifting there.
Right. It's about navigating this volatile environment, but doing it through, well, smart strategy. Yeah. Portfolio changes, real innovation.
Exactly. Volume's the big story here. And that strategic evolution, that's really what we need to unpack.
Okay, let's start with the results then. Give us the snapshot.
So first off, this is just a clean beat, pretty much across the board. Set a really positive tone right out of the gate.
Okay, lay out the headline numbers for us.
All right. Adjusted EPS came in at 81 cents.
Yeah, $1.81.
Yep, and that beat the street by, 6-7 cents. A comfortable beat.
Yeah, that's pretty significant on the profit side. But everyone was looking at the drivers, right? Especially the top line, the revenue.
Exactly. Revenue was $1,585.6 million, also ahead of consensus.
Okay.
But the number that really jumped out, the crucial one for consumer staples right now, was organic sales, up 3.4%.
3.4%. And it wasn't their own forecast lower, like maybe 1 or 2%?
Way lower. They guided 1% to 2%, so hitting 3.4% organic. That got people's attention. Big time.
Okay, so let's dig into that organic growth. Because 3.4% is strong, but how they got there is key, especially now. It wasn't just price, was it?
No, and that's the critical part. This was a volume-led quarter. That 3.4% organic, volume was up 4.0%.
4% volume growth. Yeah. That's huge in this environment.
It really is. Now, there was a bit of a drag from price mix, about minus 0.6%, but the underlying story is units moving off the shelf. That signals real execution.
And was it broad-based? Or just one specific area driving it?
Pretty broad, actually. International organic sales were up a very strong 7.7%.
Wow.
Yeah, shows global momentum. Domestic consumer was up 2.3%, and even their specialty products division grew 4.2%. So yeah, healthy across the different segments.
Okay, so strong volume, broad-based growth. Let's talk portfolio. Because that seems to be where the strategic action is. They're not just riding momentum, they're actively changing the company's shape, right?
Absolutely. Management's clearly using this strength to pivot towards higher growth areas. Look at the Touchland acquisition.
Right, the hand sanitizer brand just closed in July.
Yep. And the CEO said results are already beating their initial expectations. Consumption's growing double digits.
And the potential there seems massive, doesn't it? I think I saw household penetration is still really low.
It is just under 7%, they said. Compare that to the whole category, which is over 40% penetrated. So, yeah, there's a huge runway for growth just by getting into more households.
Years of growth potentially baked in there.
And they're supporting that with more innovation, particularly in what they call functional beauty and personal care. That seems to be the focus.
Okay, like what specifically? Any big announcements?
Yeah, a couple of notable ones. They're launching TheraBreath toothpaste in January 2026.
Extending that TheraBreath brand, which is already a winner in mouthwash.
Exactly. Premium positioning, healthy gums, deep cleaning, whitening, all in one. And then there's Trojan, G-O-A-T.
G-O-A-T as in greatest of all Trojan.
Apparently so.
Yeah.
It's a new non-latex condom with some patent-pending material, Ultraflex, for better heat transfer. Again, pushing into that premium, innovation-led space.
So adding these premium, high-growth potential brands, but they're also cutting stuff out, aren't they?
Yes, and that's just as important strategically. They're exiting Flawless, Spinbrush, and the Waterpik showerhead business by early 2026.
Take some guts to cut established, recognizable names like that. Shows real focus.
It does. It signals they're serious about profitability and focusing on the core. And then, of course, there's the big one, the vitamins business, VMS.
Right, the strategic review. Any update there?
They just confirmed it's still on track. Expecting a conclusion could be a joint venture, a partnership, or an outright sale by the end of this year, 2025.
Okay, so that's a major catalyst coming up very soon. The market must be watching that closely.
For sure. It's a big piece of the puzzle.
All right, so these are big moves, acquisitions, divestitures.
Yeah.
But you need a strong financial engine to pull that off. How did the underlying financials look? Margins, cash flow.
Looked very solid, especially the margins. Adjusted gross margin hit 45.1%.
Okay, 45.1%. How does that compare?
It was up 10 basis points compared to last year, which is good. But importantly, it was 110 basis points better than their own outlook. A big beat versus guidance.
Wow. 110 basis points better than they expected. What drove that? price finally catching up?
Actually, no. They said it was mostly productivity improvements offsetting inflation and tariffs. So operational efficiency really shining through.
And that flows through to cash, presumably.
It did. Cash from operations grew almost 20% year over year in Q3, nearly 19.6% to be exact, and they felt good enough to raise the full-year cash flow outlook to around $1.2 billion.
That's serious cash generation. What are they doing with it? Buybacks.
They did buy back $300 million in shares in Q3. That brings the year-to-date total up to $600 million.
Significant return to shareholders.
It is, yeah. But management was quick to stress M&A is still the #1 priority for that cash. They want flexibility for more deals.
Got it. Strong cash flow gives them options. So strong quarter, good cash flow leads to better guidance for the full year.
Exactly. They raised the full-year adjusted EPS guidance to about $3.49.
Okay.
And reported sales growth expected now at plus 1.5%.
And what about margins for the full year, given that strong Q3 beat?
Yeah, they improved the outlook there too. They now expect adjusted gross margin to contract only about 40 basis points for the full year. That's better than the 60 basis points they guided before.
So less margin pressure than anticipated. Did they say anything about tariffs? That was a big headwind.
They did. They actually trimmed the expected drag from tariffs down significantly, now only expecting about a $25 million impact for the year, down from $30 million.
Okay, so things are looking better operationally than they thought just a few months ago.
Definitely. And they're not just banking those savings, they're actually reinvesting some of it.
How so?
They're raising their marketing spend, planning for marketing as a percentage of sales to be over 11% for the full year now.
Interesting. So using the strength to push harder on building brands and momentum into next year.
Exactly. It's a proactive move to keep the volume story going into 2026.
Okay, let's widen the lens a bit. How does this fit into the broader consumer staples picture? What are they seeing out there with the consumer? Still squeezed.
Yeah, they said it's still a mixed bag. Promotional activity is high in many categories. But one really interesting point they made.
What was that?
For the first time in 8 quarters, the value tier in laundry detergent actually grew.
8 quarters. Wow. That's a clear signal consumers are feeling the pressure, isn't it? Trading down in some areas.
It certainly suggests that. But here's where Church & Dwight seems well positioned. Arm & Hammer, their big value play in laundry. It held its market share.
Okay, held share. That's good.
But get this, they did it while decreasing their promotional spending in laundry by 400 basis points year over year.
They cut deals by 4% and still held share, while value is growing.
Exactly. Meanwhile, competitors were apparently increasing their promotions by 300 to 600 basis points.
That says a lot about Arm & Hammer's underlying value proposition. Pretty impressive.
It really does. But then you contrast that with their premium brands, TheraBreath, Hero, the new Touchland brand. Those are accelerating.
So it's a split consumer. Some trading down, others still spending on premium.
Seems that way. The higher-end consumer is still spending, especially on these sort of problem solution, functional beauty type brands. And again, the runway is huge because penetration is so low.
What was the Hero number again?
Hero, the acne patch brand, is only at 9% household penetration. The whole acne category is at 28%.
Right. So tons of room to grow just by reaching more people who already buy acne products.
Exactly. Massive upside potential in those premium brands.
Okay, makes sense. But before we get too carried away, the Q4 guidance, it implies a slowdown, right?
Right.
Organic growth projected around 1.5% after 3.4% in Q3.
Yeah.
It's a step down?
Yeah, they addressed that. 3 main reasons. First, just a really tough comparison.
Last year's Q4.
Yeah, Q4 last year had unusually high sales because there was a threatened port strike and everyone loaded up their pantries, so they're lapping inflated numbers.
Okay, that makes sense. What else?
Second, some seasonality and just weaker trends right now in that VMS, the vitamins business. It tends to be bigger in Q4 anyway.
Got it. And the third factor?
That's the portfolio pruning we talked about. Those discontinued businesses, Flawless, Spinbrush, Waterpik showerheads, they'll be running out of inventory in Q4.
So the sales just disappear.
Right. Creates about a $30 million headwind or a 200 basis point drag on growth just from those exits. It's a planned drag, part of the strategy.
Okay. Short-term pain for long-term gain. The market seems to accept that. And strategically, any more color on future M&A? Still focus on that functional beauty space.
Yes, very clearly. Functional beauty and personal care/beauty. They explicitly said they're not trying to become a pure beauty company. Too risky.
Sticking to their knitting, but adding these adjacent high-growth areas.
Exactly. And focusing on brands that can win online. They mentioned e-commerce is already 23% of their consumer sales. They're thinking about AI, the digital shelf, positioning for the future of retail.
Makes sense. Okay, time for our favorite segment. This is not financial advice. Let's put on the slightly irresponsible hedge fund analyst hat. Stock's done well, fundamentals look good. Where's the outrageous but plausible trade here?
Okay, here it is. The trade idea is actually a short-term short position.
Short. After all this good news, stock's near highs. Why short CHD?
Okay, hear me out. It's very specific. It's a short initiated, say, now targeting that VMS strategic review deadline at the end of 2025.
So you're betting against the VMS news, but isn't getting rid of it seen as a positive?
It is, and that's the point. The market seems to have priced in a perfect outcome already. A clean, quick, high-value sale for cash by December 31st. That expectation is baked into the current price, arguably providing a bit of a premium. The plausible risk, the thing we're betting on, is that it doesn't go perfectly smoothly. Maybe the conclusion gets delayed into early 2026, or maybe they announce a joint venture or a partnership instead of a clean sale.
And that would be seen as less good, less clean, maybe less cash up front.
Potentially. It introduces complexity. If the outcome is messier or takes longer than the market's currently assuming, that specific catalyst premium could evaporate pretty quickly.
So it's not a bet against the core business at all. It's a technical bet on potential disappointment around the timing or the structure of the VMS exit.
Precisely. The fundamentals are strong, which is why this is short-term and catalyst-driven. If the VMS news disappoints even slightly relative to the high expectations, you could see a sharp pullback, even if the core business is fine. It's betting on complexity risk hitting a stock that's running a bit hot on optimism.
Interesting. A technical short against a fund fits the outrageous but plausible category.
That's the idea. High risk, specific timing.
All right. That brings us to the end of this deep dive on Church & Dwight's Q3. Let's recap the big picture.
Yeah, strong quarter. EPS beat, raised guidance, that's the headline.
But underneath, it's really about aggressive portfolio management, adding Touchland, exiting underperformers, the pending VMS decision.
And critically, that volume growth, moving from just price increases to actually selling more stuff, that's the shift the market liked.
Plus showing they can defend their value brands like Arm & Hammer, even while cutting back on deals.
Right. So the final thought, the provocative question for you to mull over.
Let's hear it.
As they push harder into these premium high-margin brands like TheraBreath and Hero and Touchland, how high can they actually push the overall company margin profile?
Without damaging the core value proposition.
Exactly, without sacrificing that price-value equation for Arm & Hammer and their other household staples, especially when you see consumers starting to really focus on value again in some categories.
Finding that balance between accelerating premium growth and protecting the core value base. That's the tightrope they have to walk.
That's the challenge and the opportunity ahead for them.
A great point to end on. Thanks for joining us for this deep dive. We'll catch you on the next one.